there. Welcome to If the Public Only Knew, where we demystify the complex world of investing. I'm your host, Gary Sinderbrand, and today we're diving into a fascinating topic: how your personality archetype influences your investment decisions, and more importantly, how to choose the right financial advisor for your type. Have you ever wondered why you make certain financial decisions? Why some investors panic sell during market downturns while others remain calm? Or why some people are drawn to high-risk investments while others prefer the safety of bonds? The answer might lie in what Carl Jung called our archetypal patterns, the unconscious forces that drive our behavior. Today, we'll explore 4 common investor archetypes, their strengths, their blind spots, and the type of financial advisor each should seek for optimal success. Stay with us. This could be the most important episode you'll hear this year. Part 1, understanding the ruler archetype. Let's start with what I call the ruler. If you're a ruler type, you're all about control and security. Picture Sarah, a successful executive who tracks every dollar in her portfolio and needs to understand every investment decision in detail. Like many rulers, she checks her portfolio daily, sometimes hourly during market volatility, creates detailed spreadsheets tracking performance metrics, feels deeply uncomfortable when outcomes seem unpredictable, prefers stable, proven investments over speculative ones, needs to understand every aspect of her investment strategy, often struggles to delegate financial decisions. Now here's the catch. While your desire for control can lead to disciplined investing, it might also prevent you from taking necessary risks or adapting to changing market conditions. Let me share a real example from my practice. One of my ruler clients refused to rebalance his portfolio during the 2020 market crash because it meant selling bonds and buying stocks, the opposite of what felt safe. This emotional response to uncertainty, though understandable, cost him significant returns during the subsequent recovery. Finding the right advisor for rulers. If you're a ruler, you need a financial advisor who has extensive credentials and experience, think CFP, CFA, and at least a decade in the field. Provides detailed, regular reports with clear performance metrics. Uses a systematic, well-documented approach to investment management. Excels at risk management and can explain their strategy in detail. Communicates with precision and clarity. Is willing to take time explaining their reasoning behind every recommendation. Maintains regular contact through scheduled updates and strategy sessions. Essential interview. Questions for rulers. What is your exact process for monitoring and adjusting client portfolios? How frequently do you provide detailed performance reports? Can you walk me through your risk management strategy step by step? What specific credentials and certifications do you hold? How do you make investment decisions during market volatility? What is your backup plan if you're unavailable during a market crisis? Can you show me examples of your client reporting documents? Red flags for rulers. Vague or inconsistent answers about their investment process. Resistance to showing actual client reports and documentation. Dismissive attitude toward your need for detail. Overconfidence or unwillingness to admit past mistakes. Lack of clear risk management protocols. Good signs for rulers. Provides specific examples with numerical backing. Shows actual risk management documentation, demonstrates systematic decision-making processes. Explains their backup systems and contingency plans, offers regular portfolio review schedules, but watch out for these potential pitfalls. Refusing to deviate from your plan even when markets change dramatically. Micromanaging your advisor to the point of paralysis, missing opportunities because they seem too uncertain. Overvaluing past performance as a predictor of future results. Becoming overly focused on short-term market movements. Check what Sure is Part 2, Understanding the Hero Archetype. Heroes, you're the ambitious ones. Think of Michael, a successful entrepreneur who's always looking for the next big investment opportunity. Heroes typically dream big about financial success and beating the market. Love hearing about innovative investment opportunities. Take pride in achieving above average returns. Have a high risk tolerance, sometimes too high. Get excited about emerging markets and new technologies. Often share investment tips with friends and colleagues. Let me tell you about a hero client who made a fortune in tech stocks, but then lost 40% of his portfolio, chasing the next big thing in cryptocurrency. Heroes, your strength is your optimism and willingness to seize opportunities. But this can also be your weakness, leading to excessive risk-taking and impulsive decisions. Finding the right advisor for heroes. Heroes need advisors who have a growth-oriented mindset, but maintain strong risk management principles, can articulate bold but realistic visions for portfolio growth, are confident and assertive enough to push back against impulsive decisions, know how to channel your enthusiasm constructively, have strong risk management skills to balance your aggressive tendencies, can provide historical context for market cycles and bubbles, excel at setting realistic expectations while maintaining optimism. Essential interview. Questions for heroes. What's the most innovative investment strategy you've successfully implemented? How do you balance growth opportunities with risk management? Tell me about a time you had to convince a client not to make an impulsive investment decision. That's your view on emerging markets and alternative investments. How do you stay ahead of market trends while maintaining disciplined investing? What's the biggest investment mistake you've helped a client avoid? How do you determine when to take profits versus letting winners run? Red flags for heroes. Overenthusiastic agreement with all your high-risk ideas. No clear risk management strategy. Focus solely on returns without discussing downside protection. Inability to provide examples of saying no to clients. Too much emphasis on trending investments. Good signs for heroes. Balances enthusiasm with pragmatic caution. Provides historical context for market cycles. Shows examples of both successful and unsuccessful investments. Has clear criteria for evaluating new opportunities. Demonstrates ability to push back with solid reasoning. Hero types, beware of chasing performance without understanding risks. Overconfidence in your ability to pick winners. Ignoring downside risks in favor of upside potential. Pressuring your advisor to make hasty decisions. Overconcentrating in familiar sectors or companies. Confusing a bull market with investment skill. Part 3. Understanding the caregiver archetype. Caregivers, you're focused on financial security for yourself and loved ones, ethical investing and social responsibility, avoiding losses at almost any cost, building trust-based relationships with financial professionals, ensuring family legacy through careful estate planning, and making sure loved ones are protected through insurance and conservative investing. Consider Maria, a caregiver client who inherited her parents' retirement savings. Her primary concern wasn't maximizing returns, but ensuring the money would last to support both her retirement and her children's education. Your strength is your thoughtful approach to wealth preservation, but you might be too risk-averse for your own good. Finding the right advisor for caregivers. Caregivers need advisors who show genuine empathy and understanding of family dynamics. Share your values, especially regarding ethical investing. Provide patient, detailed explanations of investment concepts. Excel at helping you manage anxiety during market volatility. Have a strong educational approach to financial planning. Can explain complex concepts in simple, relatable terms. Demonstrate expertise in estate planning and insurance. Are willing to include family members in financial discussions when appropriate. Essential interview questions for caregivers. How do you help clients balance family financial obligations with personal financial security? What's your approach to ethical and socially responsible investing? How do you help clients manage anxiety during market downturns? What's your experience with multi-generational wealth planning? How do you incorporate estate planning into your investment strategy? What's your communication style during market volatility? How do you help clients understand the trade-offs between risk and long-term security? Red flags for caregivers: pushes aggressive strategies despite your concerns, dismisses your family-focused goals, uses excessive jargon or complex explanations, cannot clearly explain their approach to ethical investing, shows impatience with questions about safety and security. It's good signs for caregivers: takes time to understand your family dynamics, provides clear, jargon-free explanations, shows genuine interest in your concerns, has experience with multi-generational planning, demonstrates empathy while maintaining professionalism. Watch out for making emotional decisions based on fear or family pressure, being too conservative with long-term investments, avoiding necessary portfolio changes due to anxiety, becoming overly dependent on your advisor for emotional support, sacrificing your own financial security for others, letting family dynamics override sound financial decisions. Part 4, understanding the sage archetype. Sages, you love understanding market dynamics and economic theory, enjoy researching investments and reading financial papers. Value wisdom and experience over quick profits. Take a long-term philosophical approach to investing. Appreciate historical market patterns and cycles. Often have advanced degrees or professional certifications. Let me tell you about David, a sage client who spent 6 months researching sustainable energy investments before making his first move. Your strength is your analytical approach, but you might suffer from analysis paralysis. Finding the right advisor for sages. Sages need advisors who have deep market knowledge and academic credentials, can engage in sophisticated investment discussions, use evidence-based approaches to portfolio management, provide detailed research and analysis, challenge your assumptions constructively, stay current with academic financial research, can help translate analysis into action. Essential interview questions for sages. What academic research influences your investment philosophy? How do you incorporate modern portfolio theory into your practice? What's your process for evaluating new investment opportunities? How do you stay current with financial research and market developments? Can you explain your portfolio optimization methodology? What metrics do you use to evaluate investment performance beyond standard benchmarks? How do you balance quantitative analysis with qualitative factors in investment decisions? Red flags for sages: unable to discuss investment theory in depth, dismisses academic research, relies solely on technical analysis or gut feelings, cannot explain their portfolio construction methodology, and shows resistance to intellectual discourse about investments. Stock tree wash, good signs for sages: no. Engages thoughtfully with complex questions, cites relevant research and studies, can explain multiple investment approaches, shows intellectual curiosity and openness to debate, demonstrates continuous learning and professional development. Be careful of overanalyzing decisions to the point of inaction, seeking perfect timing in imperfect markets, ignoring intuition and emotional intelligence, missing opportunities while waiting for more data, becoming too attached to theoretical models, overlooking practical constraints in favor of perfect solutions. Boros, Part 5, self-assessment and action plan. Let's do a comprehensive self-assessment. Think about these scenarios. Market crash scenario. Rulers immediately want to review their risk management strategy. Heroes look for buying opportunities. Caregivers worry about protecting their loved ones. Sages analyze historical crash patterns. New investment opportunity. Rulers want to see detailed track records. Heroes get excited about potential returns. Caregivers consider the worst-case scenario. Sages research the underlying fundamentals. Remember, regardless of your archetype, every potential advisor should be able to answer these universal questions. How are you compensated? What is your fiduciary responsibility to clients? What is your investment philosophy? How do you tailor your approach to individual client needs? What is your client communication strategy? How do you define and measure success for your clients? the follow-up process. After interviewing potential advisors, 1. Document evaluation. Score each response against your archetype's key needs. Compare answers across different advisors. Note specific examples and scenarios they shared. Review their written materials and samples. 2. Reflection questions. Did they understand and address your core concerns? How well did their communication style match your needs? Were they able to push back appropriately? Do they demonstrate expertise in areas crucial to your archetype? 3. Trial period considerations. Request a 90-day trial period to experience their communication style. Review actual reports and updates. Test their responsiveness. Assess how well they handle your questions and concerns. Remember, the right advisor for your archetype should complement your natural tendencies, help manage your potential blind spots, communicate in a way that resonates with you, demonstrate expertise in areas crucial to your needs, show understanding of your archetype's specific challenges. 1 or a final action plan. 1. Identify your dominant archetype through self-reflection. 2. List your typical financial behaviors and emotional triggers. 3. Document your responses to past market events. 4. Review the interview questions specific to your archetype. 5. Create a checklist of advisor qualities that complement your type. 6. Conduct structured interviews using the questions we've discussed. 7. Take detailed notes during advisor interviews. 8. Compare advisor responses against your archetype's needs. 9. Share your self-insights with your chosen advisor. 10. Regularly review how your archetype influences your decisions. That's all for today's episode of If the Public Only Knew. Remember, self-awareness is your greatest asset in building long-term wealth. I'm Gary Sinderbrand, reminding you that knowing yourself is the first step to becoming a better investor. Next week, we'll dive deep into specific investment strategies for each archetype, including detailed portfolio recommendations and risk management techniques. Don't forget to subscribe and leave us a review if you found this helpful. End of script.